What's going on today, you guys? So we are talking about how to invest $25,000 today. Now this is an ongoing series I've been doing. I've already covered how to invest $1,000, $5,000, and $10,000. So a lot of this information kind of repeats itself, and I'm trying to avoid that, so I'm trying to bring in new information with each video in case you guys are watching all of these. And make sure you guys let me know if you want to see me do like $50,000 or $100,000 or anything beyond that. So if you want to see those videos, leave me a comment below. Otherwise, I might stop it at this video just because at this point I've really covered a lot of the basic ways you can invest, and I don't really want to repeat myself if you guys aren't really interested in that information. What I might do though is go back through and just do solely on stock investing. So investing $1,000 in stocks, $5,000 in stocks, and maybe go more in depth like that. But anyways, here we are with how to invest $25,000. So the first thing I want to talk about before I get into what your best bets are for investing is based on how long you're trying to invest, this is what I would recommend. So if you're a short-term investor and you're looking to use that money in under 2 years, I would actually highly recommend just keeping it in cash because markets can be so volatile. Even with a mutual fund, you could end up down on your investment within 2 years. So maybe you have $25,000 you're saving for a down payment on a house. Just keep it in cash or see if you can find a CD or certificate of deposit. It will be difficult to find one for such a short term, and it will be a very, very small interest rate. But if it's more than what you're getting in your savings account, it's still better than nothing. So I would recommend looking for a CD. And again, it may be very difficult to find one that's such a short term like that. I know I have one through my bank because I have a secured credit card, and I think my interest rate is 0.25%. But then again, it is slightly more than my savings account. So if that's worth it to you, why not do that? But if not, just hold on to it in cash and don't worry about investing if you need it in such a short term. Now, if you're in the midterm and you're going to be using that money in maybe 2 to 5 years, I would still recommend a certificate of deposit or an index or a mutual fund in a good market. So if you believe that the market is very healthy and you don't see anything bad on the horizon, then yes, involve yourself in a mutual fund or an index fund. But understand that a lot of people right now are speculating that we will have a recession in the near future simply because we generally have one every 10 years. So you want to make sure you consider the market conditions because obviously if we go into a recession, markets across the board go down. So you have to consider whether or not you feel we are possibly nearing a recession before you involve yourself for such a short period of time. The longer you involve yourself, the more time you have for markets to recover. So I wouldn't worry so much in the 5 to 10 year range, but definitely for the 2 to 5 year range, consider the overall market conditions. So now we've reached the mid-long term. I would call that 5 to 10 years. So maybe 5 to 10 years down the road, you're looking to use this money. That's when I would say definitely the index or the mutual fund is probably your best option. But if you want to be more involved with your investments, you could definitely start a stock portfolio. And then we get into the long term, which is 10 to 15 years. And that is when I'd recommend a stock portfolio for sure. And then maybe if you want to be more passive with your investment, index or mutual fund is a great idea. You could also look into bonds at that point or real estate. So if you want to get invested in real estate and start maybe being a landlord and getting that income from being real estate owner there and renting it out to people, you could consider getting into real estate. But I definitely would make sure you want to be involved in that for 10 to 15 years before you think about buying a piece of real estate. And then if you're in it for the very long term, 15 years plus, I would highly recommend maxing out your contributions to your Roth IRA. I believe right now it's $5,500 a year. That is a retirement account. And I would just highly recommend if you're looking to invest super long term, before you do other stuff, why not max out that Roth IRA and then maybe the remaining $20,000 or so you could put towards something else in the list here. But if you're going to be investing that far long term, a retirement account is not a bad idea at all. But we're going to start with investing $25,000 in stocks. So we're talking about market cap here, or market capitalization. And if you guys aren't familiar with this, I did do a video talking about market cap, so maybe check that out afterwards to get a better idea of what I'm talking about. But this is the stocks based on the size of their market cap. So first we have mega cap stocks, which have a market capitalization of over $200 billion. These are the big companies, the blue chips they're called. These are the titans of the industry or the industry leaders. Often these are also dividend stocks because they're very large companies that pay a dividend. Then we have large cap stocks. They're in the $10 billion to $200 billion range. And these are like the up and coming leaders. Oftentimes these are dividend stocks as well. And then we have mid cap stocks. They have market cap of $2 billion to $10 billion. And this is what you call your growth stocks. And these tend to be the newer companies. So basically how you set up your investing portfolio is largely based on your risk tolerance, and you have a different blend of these 3 stocks here based on your risk tolerance. So let's say you're 20, 21 years old, you have $25,000, maybe you inherited some money. You have a long time to basically recover from any losses, so you may have more risk tolerance than somebody who's looking to retire in 10 years. So you have to understand what your own risk tolerance is and then basically set up a portfolio according to that. So if you're looking for very low risk, you'd want to involve yourself in 5 large or mega cap stocks, and it can be more than 5 if you want to be more diversified. Especially now with Robinhood, you know, we have commission-free trading, so that does help a lot, because a lot of the time when we were looking at investing, you had to consider your commission costs. But now we have a lot of new trading platforms where you don't pay commission, so that's no longer a factor. So you can be more diversified now. And you want to make sure you involve yourself in different sectors as well, just in case one sector is doing poorly. You don't want to be fully involved with all of your companies in that sector. So the lowest risk is 5 or more large or mega cap stocks across different sectors. Now, if you're looking for mild risk, that might be 10 to 20% growth stocks, 80 to 90% of these blue chips or these large and mega cap stocks. Medium risk would be maybe 30 to 40% growth stocks, and 60 to 70% blue chips. And then if you're looking for mid to high risk, that would be 50% growth stocks or 50% blue chips, or involving yourself or your whole portfolio in one sector. So maybe you really wanted to involve yourself heavily in the semiconductor industry. I don't know why you would. You wouldn't want to have all your eggs in one basket, but that's where you're getting into mid or high risk. Even if you're looking at mega and large cap stocks, if you're all in one sector, there's higher risk at that point, because it's more likely that one sector will do poorly than for all of them to do poorly. And then for high risk, that would be the majority to all growth stocks. So depending on what your risk tolerance is, maybe one of those fits for you. And now we're going to talk about stupid risk. These are things that I highly recommend you avoid entirely. Number 1 is the pink sheets, the over-the-counter bulletin board, or unlisted stocks. Those are stocks that you're not going to find on the major NASDAQ, New York Stock exchanges. These are also called penny stocks. I wouldn't touch these with a 10-foot pole, especially with that size or that sum of money. If you have $25,000, don't go anywhere near penny stocks. They're not going to be good long-term investments, and I wouldn't even consider them good short-term investments either. I've also done videos talking about penny stocks, so if you want to know why those are a terrible investment, I have that video on my channel as well. I would avoid biotech and pharmaceutical companies because they're extremely volatile and largely based on FDA approval of a lot of their drugs. So I don't like having my money riding on something like that. So I avoid those entirely. Also, mining companies have very high volatility. I would stay away from those, and also having all eggs in one basket. So I would definitely not recommend taking $25,000 and putting it into one individual stock. Alright, so let's say you're looking for a more passive investment and you don't want to have an active investment like investing in stocks. I would say lower risk than stocks would be investing in mutual or index funds. Obviously, what I mean by that is, you know, stocks is a more active investment because you have to keep track of them, and eventually you do have to determine the best time to sell them. So if you don't want to worry about that and keeping track of individual stocks, you could just invest in a mutual fund, and that is a very passive investment. Index funds as well. And if you're looking for a lower risk than mutual or index funds, if you're very nervous about your money, or you're just very close to retirement, or you just don't want to risk losing that money, that's when I would recommend bonds or certificate of deposits. And obviously the lower risk, I don't think I explained this on the last part here, the lower risk, the lower potential reward, the higher risk there is, the higher potential reward there is. So obviously, as you lower your risk, the actual return on investment is going to be lower, but the amount that you could possibly lose will also be lower as well. So that's why it's important for you guys to determine your own level of risk tolerance and invest accordingly. So one of my other favorite ways to invest money is to invest in a business, so something you're starting yourself. And this is the way to get the greatest return on investment. I don't think anyone can argue that investing in yourself or investing in your own business will get you the best return on investment. Now, here's just a couple of things that you can do with $25,000. Many of these don't even cost as much, and I do have a couple of these that I included a lower cost option in case you're not looking to invest all of that money. But there are a lot of low-cost franchise opportunities out there. I'm not going to list them here because I'm sure the prices of those change, but I did a little research and I found one website that had 32 different franchise opportunities that were under $25,000. You could also do a food truck, or if you're looking to invest a smaller amount of money, a food cart, because a food cart should definitely not cost you $25,000. if it is, you're buying way more than you need. So maybe a food truck would cost you $25,000 to get up and running. Definitely not a food cart. So don't be spending 25 grand on a food cart to wheel around the fair or wherever you plan on using it. You could open like a coffee or like a light food business, maybe like a breakfast place. A lot of people are doing tea shops as well now, so maybe that type of business. A clothing boutique, and if you want to go even lower, maybe you do a consignment shop where you have people bring stuff in on consignment, and when you sell it, you give them a portion of the proceeds. If you live in a nice area and you have a lot of people who buy new clothes, they could bring their gently used items to you and sell them, and you guys split the profits. You could open a pet grooming business if you have experience with that, and obviously, again, that's something that shouldn't cost you $25,000. If it is, you're probably spending too much on grooming equipment and tubs and stuff like that. You could start a cleaning business. So you could do this on a cheaper scale. Maybe you're just doing household cleaning, so you basically you'd go door to door or whatever, or go to people's houses and clean for them. But if you're looking to scale it, I would recommend commercial cleaning. Maybe invest in some commercial vacuum cleaners, some vans, well, probably one van realistically, and then do commercial cleaning of office buildings, and then you may be able to build that business over time. Obviously, the commercial cleaning would be a more expensive version, and just being a household cleaner would be a cheaper version. And then possibly consider opening a small fitness studio. If you're really into fitness and you want to do group training, you could absolutely get the equipment together to open a small studio for much less than $25,000. And then the third way that I have to invest $25,000 is to invest in real estate. Now, there's many different ways you can do this. I have a whole video. I know it seems like I'm plugging all of my videos during this, but this is just kind of like a snapshot, and if you guys want more information about any of this, I've covered all of this on my channel. So like the reason I'm not going in depth on mutual funds and CDs is because I've covered them in the previous videos on how to invest $1,000, $5,000, and $10,000. So if you want that information, just go back and check those videos. I didn't see a reason to basically just restate what I already have. But here's a couple ways you can invest in real estate. Number one is direct ownership. So basically you're going to get a mortgage on a property and rent it out. So obviously if you get positive cash flow, that's money in your pocket each month. And even if you break even on that, where basically your expenses are equal to what you're making on the property as far as rent goes, at that point you're building free equity on an appreciable asset. So what that means basically is you're building equity on something. Somebody else is paying a mortgage entirely while that asset itself is appreciating over time. So when you do go ahead and sell that house, hopefully in typical markets in a good area, you're going to sell it for significantly more than you bought it for. I'm talking like 20, 30 years down the road if you had a 30-year mortgage or something like that. Obviously for a shorter term, that's why I don't recommend real estate if you're looking to invest for less than 10 to 15 years, because there could be market correction where you could end up lower on that within a couple of years. But anything beyond 10, 15 years, you should be up in typical markets in a good area. Then there's investment groups. Maybe you don't want the hassle of being a landlord. You could look into an investment group. This is where investors pool money towards the purchase of a piece of real estate. It's often condominiums or apartments. It's an entire building. Then the management, you basically have a management company that facilitates rent collection as well as vacancies and actually putting people in those apartments. And then they also do the maintenance for a fee. And it is a high fee. So obviously there's more potential return on investment with direct ownership than there is a real estate investment group. But if you don't want to be a landlord and you don't want to have so much risk associated with that, then maybe an investment group makes more sense for you. And then the third way is to finance a flip. And this is also, I consider this a high risk investment as well. So maybe you have a friend or you know someone who flips houses and they're very good at it. They do it often and they always make money on it, or they typically do. Maybe they're looking for somebody to finance their flip. So you front them the money, they flip the house, they keep a portion of the money, and then you get a portion of the money back. Again, this is probably high risk, but essentially, like I said there, you're going to loan the money to someone who is buying real estate to flip it, and then they're going to basically have their sweat equity, which is going to be the return on investment. So obviously the idea with the flip is you buy a house that's in need of repair in a good area, you fix it up all nice, and you sell it for more than you spent repairing it, plus the cost of the initial house. And then maybe if you finance that flip, you guys split a portion of the proceeds. So that's just another way that you could invest in real estate. But honestly, there's a ton of different ways you could invest. This was just a couple of my favorite options. And like I said before, your best return on investment is going to come from investing in yourself or starting your own business. So those are always my favorite ways to invest. But anyways, guys, that's pretty much all I got for this video. If you enjoyed it, please drop a like on this and then consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.